Welcome to our channel. Today, we're diving into a step-by-step guide on how to become rich by investing in the stock market in 2025. Now, before we jump in, I want to make it clear that there's no magic button to get rich quickly. Anyone promising you that is trying to sell you something. Building wealth takes time, patience, and a solid understanding of the market, but that doesn't mean it's out of reach. With the right strategy and commitment, you can grow your wealth significantly through smart stock market investing. In this video, I'll break down everything you need to know to get started and set yourself up for success in 2025 and beyond. We'll be covering everything from understanding the basics of how the stock market works to researching individual stocks, diversifying your portfolio, and managing your investments for the long haul. So, if you're ready to build a brighter financial future, let's get started. Alright, let's start with the fundamentals. The stock market can seem intimidating at first, but it's actually pretty straightforward once you understand the basics. Think of the stock market like a giant online marketplace where companies sell little pieces of ownership called stocks or shares. When you buy a share of a company, like Apple or Tesla, you're essentially becoming a part owner of that business. As a part owner, you get to participate in the company's success or failure. If the company does well, its stock price goes up, and your investment grows. Conversely, if the company struggles, the stock price may decline, and your investment could lose value. Now, there are two main ways to make money in the stock market. The first, and most common, is through capital appreciation. This simply means buying a stock at one price and selling it later at a higher price, profiting from the difference. It's like buying a house and selling it a few years later for more money. The second way to make money is through dividends. Some companies, especially larger, well-established ones, will pay out a portion of their profits to shareholders on a regular basis, like quarterly or annually. It's essentially a way for companies to share their success with their investors. Dividends are like getting a bonus check just for owning a piece of the company. Of course, the stock market isn't without its risks. Stock prices can fluctuate significantly in the short term due to a variety of factors, such as economic news, company performance, and even investor sentiment. That's why it's crucial to approach investing with a long-term mindset and not panic sell when the market inevitably experiences some volatility. Remember, the name of the game is to buy low and sell high, but that's easier said than done. It's impossible to predict the market's short-term movements consistently. That's why, as we'll discuss later, diversification and a long-term perspective are so important. Now that we've covered the basics of how the stock market works, let's dive into the exciting part: researching and choosing the right stocks for your portfolio. This is where you get to be an investor, not just a spectator. Before you even think about buying a stock, you need to do your homework. Don't just blindly follow the hype train or listen to your friend's hot stock tip. Make your own informed decisions based on solid research. So where do you start? One of the best resources is a company's annual report, also known as a 10-K filing. This document is a goldmine of information about a company's financial health, management team, business model, and future prospects. It's like getting a behind-the-scenes look at how the company operates. Pay close attention to key financial metrics like revenue growth, profit margins, and debt levels. You want to see a consistent track record of profitability and a strong balance sheet. Also, take the time to read the management's discussion and analysis section. This is where you get a sense of the company's strategy, challenges, and opportunities. Beyond the numbers, it's essential to understand the company's products or services, their competitive landscape, and their overall industry. Are they operating in a growing market? Do they have a competitive advantage? These are all critical questions to ask yourself before investing. Remember, you're not just buying a stock, you're buying a piece of a business. So make sure it's a business you believe in and that has the potential for long-term growth. You've heard the saying, "Don't put all your eggs in one basket," right? Well, that couldn't be more true when it comes to investing. Diversification is key to managing risk and maximizing your chances of success in the stock market. Think about it this way. If you invest all your money in a single stock, no matter how promising it seems, you're essentially putting all your hopes and dreams on the performance of that one company. If that company stumbles, your entire portfolio takes a hit. That's why it's crucial to spread your investments across a variety of different assets, industries, and geographies. This helps to mitigate risk by ensuring that even if one investment underperforms, others can potentially offset those losses. One of the easiest ways to diversify is by investing in index funds or exchange-traded funds, also known as ETFs. These investment vehicles allow you to buy a basket of stocks with a single purchase, instantly diversifying your portfolio across hundreds or even thousands of companies. For example, you could invest in an S&P 500 index fund, which tracks the performance of 500 of the largest publicly traded U.S. companies. This gives you broad exposure to the U.S. stock market without having to pick and choose individual stocks. Another approach is to diversify across different asset classes. While stocks offer the potential for higher returns, they also come with higher volatility. Bonds, on the other hand, are generally considered less risky and can provide stability to your portfolio. Real estate is another asset class to consider. It can offer diversification benefits and potential rental income. However, it's essential to remember that real estate is less liquid than stocks or bonds. The key takeaway here is that diversification is about spreading your risk and not putting all your eggs in one basket. By investing in a mix of different assets, you increase your chances of achieving your long-term financial goals. Investing in the stock market isn't a set-it-and-forget-it kind of deal. It's an ongoing process that requires regular monitoring and adjustments along the way. Think of it like tending to a garden. You need to water it, pull the weeds, and make sure it's getting enough sunlight to thrive. Now, I'm not saying you need to obsess over your portfolio every single day. In fact, constantly checking your investments can lead to emotional decision-making, which is never a good thing in investing. However, it is important to stay informed about your holdings and make adjustments as needed. So how often should you review your portfolio? A good rule of thumb is to check in at least quarterly, or whenever there are significant market events or changes in your personal financial situation. When reviewing your portfolio, consider the following. 1. Performance. How have your investments performed relative to their benchmarks? Are there any outliers, either positive or negative? 2. Asset allocation. Has your asset allocation drifted from your original target? For example, if the stock market has performed exceptionally well, you may find that your stock allocation has increased significantly, potentially exposing you to more risk than you're comfortable with. 3. Goals. Have your financial goals changed? Are you saving for retirement, a down payment on a house, or your child's education? Your investment strategy should align with your financial objectives. If you find that your portfolio needs some adjustments, don't be afraid to make them. Rebalance your portfolio back to your target asset allocation by selling some of your winners and investing more in your laggards. This helps to lock in profits and buy assets at potentially more attractive prices. We've covered a lot of ground today, from understanding the basics of the stock market to researching stocks, diversifying your portfolio, and monitoring your investments. But if there's one piece of advice I want you to take away from this video, it's this. Patience is key to achieving long-term success in the stock market. The stock market is a marathon, not a sprint. There will be ups and downs along the way. There will be times when the market soars and you feel like a genius. And there will be times when the market plummets and you question your sanity for ever investing in the first place. The key is to stay the course and not let your emotions get the best of you. Remember why you started investing in the first place: to build a brighter financial future for yourself and your loved ones. Don't get caught up in the short-term noise and hype. Ignore the talking heads on TV who claim to know what the market will do next. No one has a crystal ball. Focus on what you can control: your investment strategy, your risk tolerance, and your time horizon. Time is your greatest asset when it comes to investing. The longer you stay invested, the more time your money has to compound and grow exponentially. Think of compound interest like a snowball rolling downhill. The longer it rolls, the bigger it gets. So stay patient, stay disciplined, and stay focused on your long-term goals. The stock market is a powerful wealth-building tool, but only if you use it wisely and with patience. Thanks for watching. If you found this guide helpful, don't forget to like, subscribe, and hit the notification bell for more tips on investing and building wealth. Remember, investing in the stock market is a journey, not a destination. There will be bumps along the way, but by staying informed, staying disciplined, and staying focused on your long-term goals, you can achieve financial freedom and live the life you've always dreamed of. Now I know getting started can feel overwhelming, which is why I've put together a free guide with all the resources you need to begin your investing journey. You'll find a link to that in the description below. Thanks again for watching, and remember, the best time to invest was yesterday. The second best time is today. So take action and start building your brighter financial future.